What if you could own a slice of thousands of companies for less than the price of a cup of coffee per year? An ETF, an exchange-traded fund, is a single investment product holding a basket of assets, stocks, bonds, or commodities. It trades on a stock exchange, just like a share of any individual company, all day long. Mutual funds price once at market close. ETFs reprice every second the market is open. That real-time pricing hands everyday investors the same flexibility professional traders have always had. In Orwell's financial mythology, the ETF buffet is legendary. Ledger steps through the velvet rope into a spectacular Art Deco dining hall where every steaming dish represents a different fund: domestic stocks, international bonds, commodities, each one open to any citizen with a brokerage account. The first station holds a massive paella pan labeled Total Market. One scoop gives Ledger exposure to over 3,500 companies at once. Instant diversification, served hot, no stock picking required. But the price tags aren't what Ledger expected. Some dishes cost almost nothing extra to eat. Others carry a hidden surcharge, a small percentage skimmed off the top every single year, forever. That hidden surcharge is the expense ratio, the annual fee a fund charges to cover operating costs, expressed as a percentage of assets. A 0.03% expense ratio on $10,000 costs $3 a year. Now compare that to a fund charging 1.20% on the same $10,000 over 30 years, assuming 7% annual growth. The high-fee fund quietly consumes roughly $33,000 more than the low-cost alternative. Dalbar, quantitative analysis of investor behavior, found that average investors dramatically underperform the funds they own, largely because they chase returns and ignore costs. Most people never check the expense ratio before buying. That oversight compounds, literally, over decades. A higher expense ratio does not mean a better managed fund. S&P's SPIVA scorecard, which tracks active fund performance against benchmarks, consistently shows that over 15 years, roughly 90% of actively managed U.S. equity funds underperform their index. Cost is one of the few variables investors can actually control. To understand why ETFs stay so cheap, you need to know how they're built. Large financial institutions called authorized participants buy the underlying stocks in the exact proportions the ETF requires, bundle them, and hand them to the fund in exchange for newly created ETF shares. This creation and redemption process is also what keeps ETF prices honest. If an ETF trades at a premium to its underlying holdings, authorized participants buy the cheaper stocks, create new shares, and sell them, driving the price back down. Supply and demand, automated. Back at the buffet, the variety is staggering. Ledger passes stations for domestic equity, international equity, sector funds, bond funds, and commodity funds. Each one is a distinct flavor of market exposure, built for a different appetite or risk tolerance. But can you overfill your plate? Owning 20 ETFs that all track similar indices doesn't add meaningful diversification. It adds complexity, overlap, and more opportunities for fees to compound against you. The insight is counterintuitive. Simplicity is a feature, not a flaw. A single total market ETF already contains every sector, every market cap, every industry in proportion to its real-world size. Adding more funds often just duplicates what you already own at extra cost. Vanguard's Total Stock Market ETF, ticker VTI, carries an expense ratio of 0.03%. It holds over 3,400 individual stocks. Launched in 2001, it became one of the largest ETFs on Earth by doing almost nothing fancy, just tracking the market cheaply. Consider this parallel. The Hoover Dam's construction in the 1930s made an entire desert region electrically viable, enabling cities like Las Vegas to eventually burn with neon. Low-cost ETFs did the same for investing. They wired ordinary people into markets that previously charged too much to enter. Before ETFs, building a diversified portfolio meant buying dozens of individual stocks, paying a broker's commission on each trade, and needing significant capital to start. ETFs collapsed all of that into one transaction, one fee, and in many cases, no minimum investment at all. The rise of ETFs didn't just help investors, it pressured the entire asset management industry. In 2018, Fidelity launched the first-ever zero-expense ratio index funds, a direct response to the flood of money leaving actively managed products for low-cost alternatives. The competitive pressure had stopped being theoretical. Now, for one of the most costly myths in personal finance, the belief that you don't need to start investing until you're 40. Vanguard's research shows that an investor who starts at 25 and contributes the same annual amount as one who starts at 40 can accumulate roughly twice the final balance by retirement, purely from extra compounding time. The buffet makes it vivid. Reinvested ETF dividends are the free refills. Every dividend that gets automatically reinvested buys more shares, which generate more dividends, which buy even more shares. The plate keeps filling itself, but only if you start early enough to let the cycle run its full course. ETFs also carry a structural tax advantage most investors miss. The creation and redemption mechanism lets funds swap out appreciated shares without triggering capital gains distributions the way mutual funds routinely do. Fewer taxable events means more money staying in the account. Expense ratios aren't the only cost on the menu. Every time an ETF is bought or sold, investors pay a bid-ask spread, the gap between what buyers will pay and what sellers will accept. For liquid ETFs, this spread is microscopic. For niche funds, it bites. The practical takeaway: stick to ETFs with high daily trading volume. An ETF trading millions of shares per day carries a razor-thin spread. An obscure thematic ETF trading a few thousand shares might cost more in spread than a full year of its expense ratio. Ledger pulls out a napkin at the buffet table and writes 3 questions every investor should ask before buying any ETF. What does it actually hold? What is the expense ratio? What is the average daily trading volume? Those 3 answers reveal almost everything that matters. For investors who want more than the broad market, sector ETFs offer targeted exposure: technology, healthcare, energy, without betting everything on one company. Orovale's buffet has an entire wing for these specialty stations, each one a concentrated serving of a single industry. Thematic ETFs, funds built around trends like artificial intelligence or space exploration, often launch after the hype has already peaked. By the time retail investors pile in, the early gains are gone and the expense ratios are steep. Recency bias is the enemy. Remember that opening question: owning thousands of companies for less than a cup of coffee per year? That's not a marketing slogan. VTI's 0.03% on a $10,000 investment is $3 annually. One coffee. That's the actual price of broad market ownership in 2024. The scale of that shift is concrete. According to Investment Company Institute data, U.S. ETF assets totaled $6.5 trillion by the end of 2023, up from $500 billion in 2009. More strikingly, the share of American households owning mutual funds was 40% in 2000 and had grown to 52% by 2022. A demographic expansion driven largely by low-cost indexed products. Picture a first-time investor in Orovale. No financial background, $200 saved. She opens a brokerage app, searches for a total market ETF, checks the holdings, confirms the expense ratio is 0.04%, verifies daily volume in the tens of millions, and places her first order. Start to finish, under 5 minutes. That's the checklist working. For anyone who has never bought an ETF, a single broad market index fund with an expense ratio below 0.10% is a legitimate, evidence-backed starting point. Not because it's glamorous, because simplicity, low cost, and time in the market are the 3 ingredients that actually work. The expense ratio is the one fee in investing you pay whether the market goes up or down, whether you win or lose. Check that number before you buy anything. It's the single lever you control from day one.